As tax season approaches, crypto holders should keep in mind a few things about their dealings with the IRS. Failure to do so may result in hefty fines or even penalties. Fortunately, Crypto Tax Calculator Coinly can help you get through the process with ease. But, for those who aren't comfortable filing their crypto taxes on their own, it's important to consult with a professional. Taxes on gains. What crypto holders should keep in mind as tax season approaches. Cryptocurrencies are treated as capital assets, so they're subject to taxes on gains and losses. These taxes are based on the time between buying and selling the asset, as well as your personal tax bracket during that year. If you hold a cryptocurrency for more than 1 year, you'll pay a reduced rate on long-term capital gains. However, many traders buy and sell so frequently that they only incur short-term capital gains. These are taxable at ordinary income tax rates, which can be as high as 20%. Purchasing goods and services with cryptocurrency can also generate a capital gain or loss. Depending on whether the seller is a full-time professional, these sales may be exempt from taxes. Some bills are in Congress that would exempt small purchases made with crypto from capital gains tax, but this has not been enacted yet. When it comes to spending and trading crypto, a tax on gains can be avoided by accounting for the cost basis of the coins that were purchased or received from mining or staking. This cost basis can be based on the market value of the coins when they were bought or received, or it can be based on the amount that the buyer paid for them. The cost basis is important because it enables you to subtract the purchase price from the sale price, which calculates your capital gain or loss on that transaction. It is generally easiest to use the first in, first out FIFO accounting method when calculating the cost basis of crypto. If you're unsure about the tax treatment of airdrops and forks, a knowledgeable accountant can help. The IRS has not released guidance on how to tax these events, so it is best to consult with a professional before filing. Those who trade or mine cryptocurrencies must report their profits and losses to the IRS. Using a qualified accountant can be an efficient way to prepare for the filing process and avoid fines or penalties from the IRS. Taxes on losses. As tax season approaches, crypto holders should keep in mind that their holdings are often treated as property and taxable like stocks. This means that they can be sold at a profit or loss and may have deductions, depending on how they arrived at the sale price. However, as with any property, there are some nuances to how these transactions are handled. In particular, crypto received from airdrops, staking and mining are treated differently than traditional income sources. For instance, staking rewards are generally reported as ordinary income on the date you receive them and are subject to capital gains tax when they are later sold. As such, investors should consult a CPA to get accurate guidance on how to report their crypto staking reward receipts for tax purposes. Crypto exchanges and swaps are also considered capital transactions. This is because you are disposing of a crypto asset through these transactions. This is important to keep in mind because if you are exchanging one cryptocurrency for another, you need to calculate the value of the two currencies and report your capital gains as well as your net capital losses. A savvy investor can use a variety of accounting methods to reduce their taxes on long-term gains, such as the highest in first out, HIFO, method or specific identification, SPEC ID. This allows you to pay a lower capital gain tax rate than if you held your crypto assets for more than a year. This might sound like a small advantage, but it can really add up in the long run. To give you an idea of how much you could save, let's say you purchased one Bitcoin for $10,000 in 2021 and held it until 2022. If you were in the 22% tax bracket, you would owe $1,500 in capital gains tax on that transaction. Using the wash sale rule, you can sell your crypto at a loss and buy it back immediately after to avoid capital gains tax. This strategy is a great way to harvest unrealized losses and offset your future gains. It's a good idea to use this strategy every time you sell or trade your crypto. Taxes on transactions. As tax season approaches, crypto holders must be aware of the taxes on transactions they may face. As a general rule, cryptos are considered property and taxable events happen when they are sold, traded, or exchanged. Once a holder sells or exchanges their holdings, they are subject to capital gains taxes on the value of the cryptocurrency. Buying and selling cryptocurrencies is also taxed, depending on the currency used to purchase them. If a person purchases a cryptocurrency using a fiat currency, such as USD or Euro, it is not a taxable event. Another thing to keep in mind is that if you sell or trade cryptos, you may be subject to long-term and short-term capital gains tax on any gain. This tax applies to gains on a crypto that has been held for at least a year from the date of purchase. Additionally, when a crypto splits into two versions, known as a hard fork, the new version will be considered a separate coin or token and will need to be reported on the return. In addition, when a coin or token receives an airdrop, the cost basis of the airdrop token is equal to the fair market value of the new coin or token on the day it was received. This is a significant change in the way taxes are handled on cryptos. Previously, airdrops were not recognized as a taxable event. In the past year, however, the IRS clarified that airdrops are a taxable event and need to be reported on the return. This was in response to a report by the IRS that claimed a Reddit user owed $500,000. It is important for crypto holders to understand how taxable events happen in order to be compliant with federal tax laws. It is also important to maintain clear records of your cost basis and trades to accurately account for all of your taxable gains and losses. The IRS advises that crypto owners should consult a tax professional for assistance, especially if they are highly involved with the crypto industry or have other complex financial situations. Taxes on investments. As tax season approaches, crypto holders should keep in mind that their holdings are likely subject to capital gains taxes. This is due to the fact that cryptocurrency is now considered a capital asset, which means it will be taxed the same as other assets and property when used or sold. One way to ensure that you aren't overpaying is to hold your cryptocurrencies long enough so that the gains are converted into long-term capital gains. The IRS has several different capital gains rates that apply depending on how long you hold your assets and how much you make from them. If you sell crypto held for less than a year, these gains are considered short-term capital gains and will be taxed at ordinary rates. However, if you are able to hold your coins for a year or more before selling them, the resulting gains will be long-term capital gains and are typically taxed at 0%, 15%, or 20% depending on your overall taxable income. Since crypto has become a popular investment, the IRS is now taking steps to help its staff identify and address issues related to these transactions. This includes sending out letters requesting information on your investments. If you receive a letter like this, it is important that you respond as soon as possible so the issue can be resolved. Additionally, the IRS is requiring crypto investors to register with the agency to report their crypto-related transactions and income. It also wants to know which crypto exchanges they trade with, how often and what type of crypto they purchase. In addition, the IRS has sent notices to individuals who have made trades using private keys, which are unique to each individual's wallet. These private keys are designed to prevent fraud and theft. As a result, it is crucial that crypto investors use the right accounting methods to record their transactions and calculate capital gains and losses. These methods include determining the cost basis for each transaction, as well as identifying the first asset that was purchased and the last asset that was sold. In some cases, traders can use FIFO, first in, first out, accounting.